right. Tori, are we live?
It looks like we are live.
Okay. I know
Excellent.
the bar is showing on the side, so who knows? All right. All right. Well, welcome everybody. My name is Cynthia Cohn, and thank you so much for joining us today. I'm actually here live from my living room with a special guest. No, it's not Rocky. I don't know where my dog, he's right there, if you could see him. It is not him. I have a very special guest today. And as many of you know, I own a boutique real estate brokerage here in Pasadena, California, called Cynthia Cohn and Associates. And I'm very, very proud to lead and own one of the very few women-owned residential real estate brokerages in the state of California. In fact, I have a 2-year anniversary this
Wow.
Friday, which I'm very excited about. As my real estate career has grown over the past 20 years, really so has my passion for protecting and caring for and really creating maximum results for my clients. One of the favorite parts of my job in owning this business is really bringing people together and serving as a trusted resource to my network. I started hosting these fireside chats really as a way to do just that. Each month, I invite an expert in their field to join us and answer some questions of mine and some questions of yours, and really to give insight into more nuanced industries and markets. Some past fireside chats featured that I had Cal Anton and John Thompson here with Simple Mortgage, talking about the 2021 residential real estate market through really the buyer's lens. I also have had Arizona real estate broker Yolanda Isham touching on the state of the Arizona real estate market for those of you who might be interested in moving out of state to Arizona. Sam Lamb with State Farm has joined me, really discussing, we had a great conversation on very high and high fire zones and insuring your home in these areas, and that was really great. And today, I'm so proud to have Martha Shanks joining us. Martha is a good friend, and she's been a tremendous resource for me and many of my clients that are considering reverse mortgages. Martha and her husband, Miles, have lived in the San Gabriel Valley for more than 30 years. She spent time in healthcare IT field. She's also, after that, decided to really try something new. So in 2005, she switched careers. Hey, a lot of us have done that, and moved into the mortgage industry, which is really perfect for her. After thoroughly learning and experiencing the business, Martha found a home at Fairway Independent Mortgage in Pasadena. And she has been learning ever since about the exciting world about reverse mortgages. And she really has never looked back. So throughout 2020, she transitioned 100% of her attention to the reverse mortgage market. And her goal is really to change the way retirement is done in this country. So before we jump in, I would love for Martha to share a little bit about herself. Martha, welcome.
Thank you. Thank you. Well, thank you for that introduction. Just to go a little deeper, I did start in mortgages in 2005, left that field I was in, and then about 2 to 3 years ago, kind of got knee deep into reverse and really grew to love the product. It is, as we say, there's myths and misconceptions about it. And as I learned more and more about it, I realized what a valuable product it is for folks that are in that 60 plus range. So that's what I've been doing. Like you said, for the last year and a half, I've been 100% devoted to reverse and probably will never go back. So what I wanted to do first was just give a quick update on what a reverse is and a few little details about it, and then we could go into questions. Does that make sense?
That sounds great. I mean, if we really just start right at the basics of what is a reverse mortgage, it just has one of these names out in the marketplace. People are really scared of a reverse mortgage.
Yes.
They don't really understand it. So let's just start at the beginning.
Yeah. So the way we kind of term a reverse is it's a loan that's secured on your home where the repayment is deferred. So you don't have to pay for this until you leave the home. So that's one of the things that's important. You don't have your payment is optional. And oftentimes, as we talk about structuring the loan, people don't make mortgage payments, although they can. The next thing that's really important is the homeowner retains title. Okay, we get a lot of people who think the bank's going to take the home, and we delve deeper into scenarios that they might be concerned about that happening, but in general, it's a regular loan and the homeowner retains title. The youngest borrower must be at least 62 years old to do the most popular, which is the FHA product. Although we do have spouses that are under 62, and we have a way to work through the guidelines with that. So if you have a 72-year-old with a 62-year-old or a 52-year-old spouse, we can still work that. They just aren't on the actual loan document. So, but there's a way to do that. There is no monthly principal and interest payment. And what I want to say is it's optional. So you as a loan, as a borrower can go ahead and make that payment if you'd like. A key feature is it's non-recourse, which means if the loan balance ever grows to be greater than the value of the home, you and your heirs are not responsible. So the borrower is not responsible, as well as the any heirs if the borrower passes away. So that's a really key feature that was built into the reverse for protection for the senior. Couple other things is that if you have enough equity, there's something called a line of credit, which grows. Okay, so I know people talk a lot about getting lines of credit at regular banks like a Wells Fargo or a US Bank, that kind of thing, which can be very valuable. And a lot of us have used them during our times as homeowners. The differences with this line of credit is it actually grows. You never have to make a payment on it if you don't want to, or you can choose to make a payment and reuse that. And it never moves into a fully amortized payment either. So you get to keep that for the life of the loan. So there's a tremendous amount of benefit with that line of credit beyond what you normally see with your regular lines of credit you get at the bank. The other key thing that a lot of our financial planners and CPAs and accountants love is the income or the money you pull out of your reverse is non-taxable. So in today's environment, when we are looking at potentially rising taxes and things like that, this is another way for you to pull money out and not have it end up on your 1040s. So that's a really important point, and a lot of the financial planners right now are looking at the reverse mortgage as a way to pull money out and not add to their client's income. Couple of things that I will say that are objections that I have to work through when I speak to people is, again, that concept, is the bank going to take is the bank going to take over and take title? Absolutely not, unless the only way it can be due and payable is if you're not paying your property charges like property taxes and insurance. If you're not maintaining the home at a minimum level, and we can go deeper into that, and you have to have it as your primary. But as long as you do those three things, the bank can't take title of the home. So that's an important point. The other thing, go ahead.
Question, because just explain one more time.
Yes.
What's the actual significant difference between a conventional loan and a reverse mortgage?
So with a regular conventional loan that a lot of people get or decide to get, you make a payment every month, and that interest, you pay it down essentially. So you're paying down your balance, and your balance is getting lower each month. With a reverse mortgage, the difference is your principal doesn't change, but there is the interest that gets added to the back of the loan because you're not making that mortgage payment. So the principal stays, and then the interest gets added to the back of the loan. So the big difference is you don't have to make that mortgage payment. And what we see is right now we have rates on our reverses somewhere in that 2.5% to 3% range. So we're looking at basically the same rates. So the biggest difference is you do not have to make a mortgage payment. You do have your interest that adds to the back of the loan. I don't know if that answers your question.
Yeah, that's great.
Yeah,
that's great. Wonderful.
Okay. The only other objection that I kind of wanted to bring up, and then we can go deeper into whatever you want, but I think we sold this product wrong, and we sold it as if you need cash, call us kind of thing. So, that's really what we've done in the past. And I do have needs-based clients. I have people that are running out of money. They're 99 and they still need help with costs and things like that because they don't have long-term care. I get it. And those people still exist. But we also now see people that are lifestyle clients, meaning they want to replace their roof. They want to, go on a trip with the grandkids. They want to help with education. They, those kinds of things. They're not necessarily in any kind of hole or anything, but they just want that additional cash or access to it. And then we have our next set, which are planners. You know, they work with their financial planners, and they work with the reverse mortgage against their retirement assets, and they're able to coordinate those so they're taking money out of their retirement assets at the right time, because mostly it's taxable, and they're taking their money out of the reverse mortgage when it's feasible because it's non-taxable. So there's a lot going on over that with our planners, and we see a lot more people utilizing reverse in that way. So it's not kind of your mom's or your grandma's reverse mortgage anymore.
Well, it sounds like this is a really great way to preserve the wealth that you have bought, more of the liquid or retirement assets, and to use the home as a way to, provide maybe a safer environment for you to age in place. What would be some other reasons to use a reverse mortgage?
So I have people who are choosing to do it to buy a second home. I've had people, so maybe they're interested in, I'm losing you, hold on, let me get back. I have people that are buying a second home, maybe they're buying an investment home. So we've actually had people who took that line of credit, made a down payment on an investment property, paid back that line of credit, bought another investment property, did the same thing, and a third time. We've had a client that did that. So then suddenly they have 3 investment properties. Now we'd have to take a look at that in the state of California, I admit that. But you know, they do that, or they do, like I said, the second home. A lot of them are using them to maybe do a Roth conversion. So they're in a 401k right now that is taxable. So they convert their taxable dollars into a Roth IRA, which is non-taxable after you put it in. So we have people that are utilizing the funds to be able to counteract those taxes that they have to pay. So we have those kinds of things. We have those, people looking at it that way. I have a client right now who's 99, and she needs it for her basic, $15,000 a month for her monthly payment, just to have people coming in. So I do have those needs-based people as well.
Okay. So people that are aging in place, that maybe
have aging in place. That's exactly right.
Full-time caregivers. So that's one reason. That way they really don't need to dip into the retirement accounts. Is that they'll use?
Yes. Yeah. Okay. Yeah, exactly. So I mean, another one that is a nice way to do it is people that are in those early 60 years. They eliminate that mortgage payment. And let's say it's a $1,500 a month mortgage payment. They can choose to do with that mortgage payment what they want. They can use it in their quality of life to expand their quality of life. They can give it to a financial planner, right? So if you're in your 60s and you want to eliminate that mortgage payment, you can do something with those dollars. And if you have enough, you can start that line of credit that over time will grow. So in that 10 to 20 to 30 year period can grow. I mean, I have one right now I'm working on. He'll end up eliminating his mortgage payment and start off with maybe a $75,000 line of credit that if he doesn't touch, it'll grow. And he's got a $1,400 mortgage payment he no longer has to make. So there's just a million different ways to take a look at this product.
That is really, really terrific.
Yeah.
So I hear you, really to eliminate your monthly payment of your mortgage that you might have now. You can use that money to maybe make another investment. You can use that reverse mortgage to help you fund aging in place, which is terrific. And any other reasons of why someone would get a reverse mortgage?
Yeah, so aging, I mean, I'm just trying, we have the people who say, Martha, I want to eliminate that mortgage. I want to eliminate my debt. I want to go ahead, and I've got this credit card out here and I've been struggling to pay it off. So I do have people who do that. I have people who want to do expansions on their home. So they might pull it out for reasons for doing that. And then other people, like I said, will eliminate that mortgage payment. And if they're really diligent, they'll take that mortgage payment, they'll give it to their financial planner, and they'll go ahead and that financial planner will use it as, additional retirement assets that they're building. So we see that happen a lot too.
I love it. It seems like there's just lots of opportunity with the product. So what is the actual difference between a reverse mortgage and a home equity loan then?
So with a home equity, you don't have the same level of protections. That product can actually grow to somewhere between 20 to 22% if you read the fine print. It can go to 20 to 22% interest rate, which we don't have nearly. We have caps on ours. It can actually be, I don't know if it could be officially called, but it can certainly be frozen. Okay. In the reverse world, that line of credit can never be cut off that way. You will always have access to it. That's what's built into it. It doesn't grow, it's stagnant. So if you get $100,000 line of credit, that's what you get, right? In the reverse world, that actually grows by 2.5 to 3.5%, depending on how, what interest rate we work through with you. So that's growing every year, as long, right along with your loan balance, that line of credit's growing. If that line of credit ever grows, greater than your value of your property, you still have access to it. Okay, I know that sounds really counterintuitive, but if you let that line of credit grow and you're in the right situation, you could be $20,000, $30,000, $40,000 combined over your value. You still have access to it. And if the FHA is responsible for covering that difference. So what people don't realize is they have access to that. Another key thing is with your equity line of credit or with your home equity line of credit, in 10 years, people forget it turns into a fully amortized payment that you have to pay back in 20 years. With the reverse line of credit, it remains as a line of credit for the life of the loan. It never turns into any kind of payment that's due, okay, until the end. So does that help with some of the?
Absolutely.
Yeah.
It's really very interesting. So explain to me this, because I know we had this conversation, and I actually have some clients that I was thinking about connecting you to who are relocating out of state.
Right.
And one of the clients is towards retirement. She's not sure exactly when she's going to retire. She can continue working. She's like got a job like we do. She could probably do part-time and then just like ease into retirement in that way.
Right.
But they have a property here they're going to sell.
Right.
They would like to own a piece of the earth on the East Coast.
Right.
And make their home there. So explain to me exactly how using a reverse mortgage might be a possibility for that particular family.
Right.
It might be similar to many of us out there listening.
Right. So you were bringing up another use of this, which is one of the most powerful pieces, and that's the reverse for purchase. So later in the game, like 2008 or so, they finally got around to allowing, putting out this product that allows you to actually purchase with a reverse. Mm-hmm. So just to kind of give perspective, I just closed on one for an 80-year-old out in Rancho Cucamonga who bought a house. Just to kind of give perspective, bought a house for $665,000 and put down $284,000. And that's all. She never has to make a mortgage payment. That payment is optional. So with a reverse, just a big picture, and then we'll get to the East Coast part. With a reverse, basically you identify what the loan amount is on the reverse, and you just come in with the down payment. So it's similar to a conventional where there's a loan, but based on your age and the value of the property, we determine what that down payment is. Mm-hmm. It's typically a little larger than 20%. But we come down with a payment, and then we go, and then that starts the reverse mortgage. So in the case of your couple, or the people that want to move, say their home is $800,000 here, and they sell that, and they, let's say, have a $200,000 loan, and I'm just being really simplistic, and they end up with a $600,000 net proceeds. They can take that money, and then they can go to the East Coast, and they can purchase on the East Coast. And they may or may not use the entire $600,000. So instead of maybe putting $600,000 down on an all cash, they can put themselves into a reverse purchase and not put all that $600,000 into that purchase, and it becomes an illiquid asset, right? So they can't access it ever unless they sell the house or refinance. So the big thing for us is you don't have to take that whole $600,000 and put it into a house and never have access to it. So, so that's one of the things that we talk about a lot with people. Now they have to move to that house and it has to be their primary. So I always go back to what's due and payable, right? So it becomes a due and payable if it's not your primary, if you're not maintaining your property charges, and if you're not maintaining the home at a minimum level.
Yeah, I think it would be, it sounds, I'm going to make the introduction because I really feel like for them, this could be something that they could consider for sure, because it'll allow them, her not to have any payment,
Right.
to put down just a portion of her,
Right.
from the sale of the house. And she'll have that extra cash. So as she ages and she needs more,
Right.
she doesn't have the burden of a monthly payment, which would be at, probably
Yes.
higher.
Yeah.
Potentially if she just went in and did a regular loan. And she'll also have the liquid.
Yes.
Is there a certain age range that the reverse as a purchase it works best for?
Not necessarily, because people, so the way I would say it is that, 62 is when the FHA product becomes available to you. And obviously it's an age-based product. So you don't get as much out. You don't get as much out when you're 62 than when you're 92. So when you're 92, the age the age limit is obviously going to be a lot less. So, but I would say, you always want to take a look at the numbers, especially for the HECM for purchase or the reverse for purchase. And we always say the sooner you put it in, the better. Okay, so if you were going to talk to Harlan, who's our executive director, he says anybody that either has a mortgage already that at 62 to eliminate that mortgage and start using those dollars elsewhere. So we're always saying, hey, at any time. Now, if you're planning to move like she is, then obviously you don't want to put it on the one now, you want to put it on the one that you are going
absolutely.
to. So you have to kind of decide, is this my forever? So I always ask, is this your forever home? And if somebody says, well, I always say, okay, well, if you're going to move, what's your time frame for moving? Because if you're not going to be there for a couple of years, then it probably doesn't make sense to step into a reverse at that time. So once you find it's close to a forever home or is your forever home, then that's when you want to jump into that reverse.
All right, that's great. Well, and you brought up like payment options. What are the payment options for a reverse mortgage?
So interestingly enough, the payment option also with reverse is completely variable and up to you. Okay. So you literally can make $1 payment, you can make $1,000 payment, you can make a $5,000 payment. So it's completely up to you. Now, I think what we would always say is let's figure out what you're making the payment for and why. Because maybe you're adding to the line of credit, because when you make a payment and you have a line of credit, it's dollar for dollar. So you do get that money back. But is that the right use of the money? I mean, if you have $500 to give to your mortgage, maybe it's better to give it to your financial planner who can make more money on that. Okay, so we really push people to look at financial planners where they can maybe earn more on that than they can earn on the line of credit. But so you can, like I said, you can define whatever you want. The only thing we ask is you don't fully pay off the loan because you want access to that line of credit. So once you put yourself into a reverse and you have that line of credit, we always caution people, don't pay off the loan piece entirely. I mean, you want to keep $1,000 in that loan product. The other thing I just want to point out before I forget, Fairway is at this point in all 50 states. So I do want people to know if they're moving out of, we do see some people moving out of California. We have people everywhere. I'm not necessarily licensed in those other states. I am licensed. My office is licensed in Arizona. But I just want people to realize there is availability through Fairway in every state at this point.
That's great.
Yeah. So when people say I want to move, I always go, okay, well, where? And then we connect them. We've had that happen in Texas and Nevada and Oregon. So,
that's terrific. So how does actually the reverse mortgage affect like the heirs?
Right. So that's another objection that people bring up to me, and they say, what's going to happen to my kids, and are they going to have a bill at the end, and that kind of thing. So when the last borrower leaves the home or passes away, then you do get a letter from, let's just say FHA, that says, we're sorry for your loss. Tell us what you're going to do with the property. And they have a couple options. One is they can refinance the reverse into their own name. or they can sell the property. But the thing I try and tell people is it's very much like a regular mortgage, like you would use when you're selling a home. And if there's a mortgage on the property, we get what's called a payoff demand. It's a very similar process. So I always caution people and say, it's okay. You just have to know what your exit strategy is as an heir. And if the loan amount is greater than the value of the property, it's a non-recourse loan, so you aren't responsible for that. Okay, so they can't be held responsible for any difference in between the loan amount and the value. And let's say, their parents pass away and it's an $800,000 house and there's a $400,000 mortgage. Their option there is to refinance it into one of their names or all their, whatever they want to do from an heir perspective, or they sell that house and then they distribute the 400,000. So that money is always goes to the heirs if there's equity left.
Oh, okay. All right. Terrific.
Yeah.
Let's say, what do I say to my clients that might be concerned that the bank will take their home?
So really the bank doesn't want your property, as we always say, and that's true in the reverse case as well. So I'll just repeat this. You have to maintain your property charges, right? You have to maintain your taxes and your home insurance and your HOAs if you're in a condo. So if you don't maintain those, people will take steps to foreclose on you. I mean, which is what happens in today's environment with any property. You have to maintain it, meaning they don't want you structurally, having the roof cave in and all this kind of stuff. They want to make sure the house is maintained. The last thing they want is you have to live in it. So you have to maintain the home. You have to be it has to be a primary residence. Yeah. Okay. So when you ask back, can they take title? They really can't unless I think the worst would be if you didn't make your property tax payment and your insurance payments.
Yeah. I've noticed, that's interesting. I've noticed that on every single transaction that I have worked with a seller on is usually like a successor trustee and their loved one had a reverse mortgage. We will first pull up, of course, the title report and we'll take a look at it. And often, I know I just had a big one last year where the loan that was recorded on the property was much higher than even I even think like the value of the property. I'm trying to remember, but it was really, really high. Why is that?
Right. So excellent question. And most people, most people don't even notice that detail. So when they put that on the property, they do it at, there's a calculation they do. And I'm going to say very simply, it's like 1.5% of the value of the property, because this loan is available to a borrower until they turn 150. So it's actually written in the note. So what they're doing is just making sure that they can cover whatever the expenses are in the loan. So it's nothing more than that. So I have had people call me up and go, oh my God, there's this lien on there for $1 million and our mom's home is 500. What are they talking about? And it's simply to maintain, to allow, them to cover what their costs are for that loan. So they give a lot of leeway. So that's why that loan, that's so high, that's calculated so high.
Interesting. So it never happens where actually the value or the owner of the property uses more than what the loan is. They live longer than is expected. Does that ever happen?
Yeah, it does. I mean, we have people that, well, I will say this. We have people, like I'm working on a 99-year-old. We have people that I think in South Dakota, we have a husband and wife that were 102 and 104, and we did the loan for. So we do have people who live a long time. Yeah. But even if that loan amount ends up higher than the value of the property, because it's non-recourse, there's nothing they can do. Now, that 102-year-old and 104-year-old will get more out of, that loan amount is going to be higher for them than it would be the 62-year-old on that same house.
Right.
So they'll get started sooner and they'll get more money because the expectations are not going to live more than 3 to 5 years. I mean, I'm just that's what they're thinking, not me. I hope they live forever, but so that's going to be the difference. They will get more out, but the expectation is not going to live as long.
Right. So. Okay. Very interesting. And just to kind of wrap it up, and I know we have some questions. So remind us again, who is a good candidate for a reverse mortgage?
So we think it's a wide net, I'll be honest. We think anybody who's 62 plus that's got a mortgage, we always like to take a look at it and work through the numbers. Even more is somebody who's 62 plus that has no value on, no loan on that property, because what they do is they get started with that line of credit immediately. So, whatever you have on that is going to be a line of credit as opposed to, erasing that mortgage. So we think anybody that's over 62 should take a look at the product, and particularly if they're looking at it as their final home.
Yeah, I really love that. And I think you just made me think of something. I think even for myself over the last few years, because I went through a divorce, really have been looking at my financial picture and figuring out, okay, let me just like really evaluate, where am I currently? Where do I want to go? And, just employ, having a friend look at my loan or figure out,
Yes.
do I need to refinance? Do I, what are some options for investing? Really looking at the whole picture and figuring out what it is I need to set myself up for success for the future. And just like everybody who's listening on this call, having Martha look at your existing mortgage, talk about what your future is in regards to how you want to age in place. I know Mary Winters has a gerontologist in town, has an amazing program that you could go through and sort of figure out what you want your later years to look like. And I think all of these things layer right into even Mary's plan. Okay, well, I really appreciate that. I know that we have some questions. Tori, are you here?
I am here. And Martha, you mentioned the importance of maintaining your home. And we have some people asking for details. Could you walk us through what maintaining your home well looks like?
Yes. So we're not looking for, upkeep that's, super clean or anything like that. Although I do walk into a lot of senior homes and they're beautifully maintained. What we're talking about is, like I said, kind of no leaks, roof not caving in. There's no reverse mortgage police out there that's like going to run by your home and go, oh my gosh. So it's not like that. But if there were some damage that happened on the home, we've had people that pulled down walls and things like that. They could come back and say, okay, you can't do this to the home. But generally maintaining the home is just what we all do. And so I don't see that. I honestly have never seen a case where that was an issue. So it has to be something really dramatic.
Why is that? And I have not heard that for just conventional financing.
That's a great question. I don't know why. That's a great question. Like, it doesn't come up on the conventional side, right? Yeah. So I don't know why on the reverse side, why they decided that was a key thing. I mean, that's one of the 3 tenets of it. So it is an interesting question. I've never really researched that to find out why on the reverse side they asked that question. So make that. Yeah, that's a good question. I don't know.
Exactly. Well, we'll have to find it out.
Yes, I have to do my we have a great knowledge guy that I can shoot a question to.
I'd be curious.
Yeah.
Tori, were there any other questions?
That's it for now.
One thing I wanted to say, and you were great at the very end because you were talking about your own personal thing. I think that's really important because, and I know you probably are set up with a financial planner and all this kind of stuff, is to work through, because at some point you want to use your house to work for you. And I know that you have children, and I get a lot, well, I want to leave my house to my kids and blah, blah, blah. And I think part of what we have to talk about in California is Prop 19 and the impact of Prop 19, which means, there are requirements for your children to take the home that you have, as you know. I mean, you probably had to, talk about that with people, and really think about your house as a way to utilize that liquidity in that home if you can, and maybe reduce a mortgage payment and give that to your financial planner. I can't say that enough. And that money can then be given to children if that's what your choice is, because that'll grow even at a greater rate. So I really want people to think about that when they get caught up a little bit in, I want to leave my house to my kids. Well, there are now requirements with that, as you know, in terms of, the property tax base and the fact that the child has to move in. So
Yeah, absolutely. And
Yeah.
that is just such a great point because there's just so many facets to it. My little facet on the the residential real estate side, but really just, selecting people to support you in your
Yes.
the financial house is in order for
Yes.
your children is so important. And these are just like you said, the single family home that you own quite often is a family's largest investment. Every time I'm selling, most of the time their
Yes.
home and the equity in it is their largest um, asset. So,
Asset.
well, Martha, is there anything else you feel important to share today?
No, I think we covered a lot of bases with this, so I appreciate it. Your questions were excellent. So,
Well, thanks. Thank you.
yes.
And I'm just so appreciate your time, Martha. It's always really a pleasure to see you. And I'm very grateful for our friendship and working together with you. I'd love to continue finding ways to support you in your business.
Well, thank you.
And,
Yeah.
and this is just one way we can do it, but I hope to be able to make some really great, wonderful referrals in the year to come. And so if
Great.
any of you on this call today, if this conversation really interests you in any way, really, please do not hesitate to reach out to me via email or phone. I'm very accessible. My team is accessible. We're around 7 days a week between 9 and 5. We answer our calls, phone calls that come in within 3 rings. We respond to our text messages and emails right away. And you can reach us at 626-714-6808. And you can also just email me directly at cynthia@cynthiacohn.com or visit us on our website at cynthiacohn.com. And again, I'm the owner of Cynthia Cohn and Associates, one of Los Angeles's few, very, very few women-owned residential real estate brokerages. We're an independent firm, and there's really nothing more important than you, your dreams, and your goals. And our mission is really very, very simple. This is simple, right? It's really just to provide your family unmatched value by delivering world-class protection, heartfelt care, and guaranteed results when you really need and deserve it most, when you're selling your largest asset. So if you're interested in selling or buying a home, or you just have some questions, just don't hesitate to reach out to us. Really here as a resource to you. And as you can tell, I have some great friends like Martha that I would love to refer you to. I will definitely be sending out a follow-up email to all of you with more information, including Martha's contact info. But Martha, why don't you tell us the best way we can reach you?
Sure. So again, I'm at Fairway Independent Mortgage, and I'm accessible via my phone. Again, just like Cynthia, 626-253-6548. It is a cell phone. I take texts all the time from family members that are interested and have questions, and then we can connect. So yeah, that's probably, and I have an email address if you want to put that out there as well. It's kind of long. So
okay, we'll definitely
yeah,
send that out. So thank you for answering everybody's questions. Sure. And thank you to all of you for joining us today in my living room.
Yes,
Fireside Chat. I hope you guys stay warm. Have a wonderful rest of your evening and a wonderful weekend ahead. And thank you for joining us today. Cynthia Cohn. See you soon.